Okay, wonderful. Thank you, David. So firstly, I just want to make sure everyone can see the presentation. So if you can't see, just mention in the chat and then, we'll make sure that works. So today's presentation or Investing 101 session is all to do with macro indicators and stock market performance. It's going to be primarily hosted by myself and Henry. That's, the main subject, but we want this to be kind of very, back and forth. So we're going to ask lots of questions and kind of get some Q&A going. So without further ado, let's just do kind of a quick recap. Was anyone here at session 3? I'm sure you all were. It was very exciting. We covered very exciting topics, and and I think let's just move on to just brief introductions. So Henry, do you want to just do a quick 30-second intro, just in case someone's new?
It's this slide again. This slide's been on every presentation, hasn't it?
It's a great picture, that's why.
If anybody wasn't at the last 3, my name is Henry. I'm kind of doing a lot of the Investing 101 with UAB. I love investing. Investing's great. I've done a bit of corporate experience, kind of on the buy side and on the sell side. I study economics, but I don't really do much work. I actually spend most of my time investing, and spend a lot of time just researching, enjoying making these presentations. That's pretty much me. I'll keep that brief because I've done that 3 times already, but I will be dipping in and out of Amrit's beautiful presentation tonight.
Wonderful. Thank you, Henry. So kind of brief introduction about myself and kind of why it's relevant. So currently a PhD finance student at UOB, focuses on sustainable finance and the effect of like ESG policies on company performance. The key part kind of before I did a PhD is I worked as an economist in the city. I actually worked on something called a purchasing managers index. So I worked on one of the main products which we're going to talk about. And I've got some fancy quotes from myself in the Financial Times, which I'll show off about. And that's kind of the just a brief overview of myself. So what's on today? What are we doing? So we are explaining macro indicators such as inflation, interest rates, manufacturing numbers, and helping you understand what these actually have an effect with on kind of financial market stock prices, just so you can kind of get an idea of, what GDP has to do with, stock prices, etc. So let's just recap. So fundamental versus technical investing. Fundamental investing analyzes underlying economic factors and their relationship with business processes, typically more long-term. And kind of just to give you an idea, so let's say if there's a shift in, inflation or a shift in interest rates or a shift in GDP, what that has to do with individual businesses. So that's what I mean in this case with kind of fundamental investing. Secondly, when we're talking about kind of technical investing, we've got kind of the underlying graph patterns, behavioral psychology, more short-term, affected by news announcements and affected by kind of comments by policymakers and the like. So let's just recap. So we're going to be doing a deep dive on macro variables. And to kind of start with that, I want to kind of ask a question for you guys. So what do you guys think an increase in inflation, or why do you think an increase in inflation lowers stock returns? So I want to kind of give you guys about 30 seconds just to have a think. And then I'll either pick on someone to kind of provide an answer, or if you want, submit an answer via the chat function. So why does, an increase in inflation, so an increase in the amount of, the cost of goods and services, or a sustained increase in the price level, why does that lower stock returns? So David, do we have any answers or any statements?
No one in the chat so far, but we'll wait. We'll give it another 10-15 seconds.
Okay.
Okay. Joe Wilson said because the gain in dollars or money is worth less.
Definitely. What I'd say to Joe is, think through, so that's the first effect. The value of money goes down. There's other effects that kind of lead on to that. So I tell you what, let's see if there's a chat. Is there more?
Here we go. Yeah, sorry.
Lower purchasing power. Yeah, definitely, you're on the right track. So I think I'll put, I'll reveal the answer now. So Okay, can you guys see? So you've got an increase in inflation, you're going to have an increase in interest rates, and therefore an increase in the return on cash, and therefore a decrease in equity investment. So let's kind of go into kind of these transition mechanisms, as well as what Joe said regarding the lower purchasing power. So so inflation goes up. So let's say inflation is running at 2%, and then it goes up to 4%, so it doubles. What does that mean in practicality? So it means that the cost of goods and services has increased by 4%. It means that if you want to buy the same thing a year from now, you're going to pay 4% more. So that means the value of your money has gone down. So what do central banks do, or what do governments do to counteract this? Well, they increase interest rates. So why would they increase interest rates? They increase interest rates to slow down something called the velocity of money, slow down the amount of money being kind of spent in the economy, and therefore kind of reduce the amount of cash available to buy these goods and services and reduce the amount of inflation. But what does this do in practicality? Well, if you increase interest rates, as you guys are aware of in your bank account, you kind of earn a little bit more. So instead of 0.1%, you'll earn, I don't know, 0.2% or something. Or if we're lucky and we have a high interest rate world, you'll earn, let's say, 5 or 6% on your money. If it's a case that you earn, let's say, 5% on your money in the bank, when you look at the different asset classes to invest in, and you look at, let's say, stocks or bonds or real estate, when you look at, let's say, a stock market, which typically returns 7 or 8% a year, you're going to be disinclined to go there, especially if you're risk averse. So if you think, you know what, I don't really want to risk my money and earn 8% a year. I want to stick it in the bank and I'll earn a little bit less. I'll earn 5%, but at least it's a guaranteed 5%. The government's got my back with that money. They'll bail me out. But if I put my money in the stock market, I might earn 8% this year, but it might go down 30%. So I'm not sure. And so as such, the equity investment or the flows towards the equity market falls, and therefore stock prices as a whole, in general, they would decline. Does anyone have any questions on this kind of analysis? Or Henry, have you got anything you want to add?
I think one good thing to add might be, so yeah, obviously you've got inflation going up, causing interest rates to go up. I think just really hammering the point home as to why you would see governments wanting to curb that inflation, because interest rates going up, like it's never an easy decision, right? Like, and to make borrowing more expensive for everybody, causing a slowdown in the economy, you have to ask why that would be more important for a government to do that and to risk an economic slowdown in order to curb this inflation. And you know, there's quite a lot of reasons for this, and it's not all that simple. But if you've got, as Amrit said, velocity of money changing very, very quickly, you've got prices going up and up and all over the place. That causes a lot of uncertainty in the economy, and that's where people become very, very cautious, depending on how this inflation is brought about. For example, if people's wages aren't going up at the same rate as prices, right? If it's not inflation that's caused by wage growth in the economy, people's disposable income, their real disposable income, is going to be knackered, right? If your wages are, say, going at the normal rate at 2% a year, and the average value of money is depreciating at 8% a year, or inflation rising at 8% a year, your disposable income is massively reduced, and that can be a big problem. There's a lot of other, people aren't incentivized to save, and also if you think about, say, for example, if you were an export economy, and you export a lot of goods and services, right? And the value of your currency was going through the roof, and inflation was, then what's that going to do for your international trade? Anyway, there's a few points I wanted to add. Is that, like, inflation got all kinds of problems, and that's why the government would be comfortable raising interest rates in order to curb it.
Definitely, Henry. I think the one thing I really want everyone on the call to kind of understand is these things are very generalized, and in any market whatsoever, you're always going to find country, companies or country economies that perform, in a complete opposite manner. So, for example, during the 2008 financial crisis, Avis, the car company, they had I think like a 10,000% return on their money from March 2009 to the end of the year. So if you think about it, there's always going to be specific companies in specific markets with specific kind of structures which allow them to prosper. But the main point is, these are general, but they're going to help you kind of understand as a whole what's going on. And definitely the type of inflation really matters, which is what we'll discuss kind of when we go into inflation more in depth. So moving on, what do we mean by macroeconomic indicators?
I'm sorry to jump in, mate. We just had a question in the chat from Joe Wilson, which is, would it be risky for a government to increase the interest rates these days with so much debt?
Honest answer is yes. So it's definitely, I mean, with the, okay, let's take the US, for example. They've got about $20 trillion worth of debt. I think I was reading the other day, their average interest rate's about 1%. Let's just say, for example, it doubles to 2%. So what's an annual servicing cost at 1% increase is 200 billion a year. The US kind of tax revenues around 4 trillion. So they've just increased they'd have to increase taxes by 5% just to pay that increase in interest rates. So to answer your question, it's very risky, and we're in this kind of situation where we have so much debt on a government level, on a private level, on a business level, that central banks are kind of they're put into kind of a very tricky situation where even if they raise interest rates by 0.25% or 0.5% or even 1% over kind of the medium term, that's a lot of money that's going to suck out the economy and just kind of create a drag. Basically it's very risky. It's why you kind of have just as Ethan said, people printing money or people proposing to print money. But I hope that answers the question. Yeah. Is there any more, Dave?
No, that was it. Feel free to. Sorry to interrupt you.
No worries. Okay, so macroeconomic indicators. So what they are, it sounds like a big word, but all they are is just statistics that reflect the performance of the economy. They vary in frequency, impact, and meaning. So, they could be very closely watched, not closely watched, and they could have kind of, a very wide impact on the market or not so much. So what we're going to cover today are interest rates, GDP, gross domestic product, so which is kind of the value of output for the entire economy, inflation, which is what we discussed kind of earlier, employment and private surveys, which is kind of what I specialize in, called the PMIs, or Purchasing Managers Index. So if we move on, there you go. Can you guys see the interest rates page?
Yep.
Okay,
yeah.
Cool. So what are interest rates? Well, in this case, we're looking at interest rate announcements. They're central bank decisions or government decisions that set the base level of interest rates for the economy. Put simply, just like that. So, for example, in our country, the Bank of England would come out with their base rate announcement. I think currently it's 0.1%. Yeah, there you go. See, Henry's smiling, got it right. That's good. And every month they come out on with these announcements, and they affect the level that that banks can borrow from them, and that as such they affect the level of kind of that we get from our savings, and as well as the interest rates we pay on our debts. So how does this affect the stock market? Well, it's kind of similar to what we did kind of earlier with inflation, and there's kind of two main effects. There's a direct effect and an indirect effect. So in terms of directly, I mean, as you guys would expect, interest rate decisions affect the amount a company can afford to borrow. If you guys remember in the previous in the previous kind of investing 101 class where we discussed the debt ratios or leverage ratios, companies are able to borrow a certain amount based on the interest rate level due to kind of the amount their cash can actually the amount of cash they generate if they can actually pay their bills. So if interest rates go up, the amount that they can borrow goes down because they're still earning the same amount of money and they can only afford to justify a certain level of debt. So if interest rates go up, what happens? What makes it more expensive to borrow? And as such, firms, they're going to borrow less, so they're going to spend less. So what does that lead to? That leads to slower growth and weaker earnings for companies, because this works in the private sector with companies as well as with individuals. If interest rates go up, you're not going to borrow so much to buy a house, or you're not going to be able to buy a house. As such, if you don't buy a house, you're not going to go renovate it. You're not going to go, buy all these, I don't know, fancy kind of home appliances or anything. that spending leads to less revenue for companies, slower growth for them, weaker earnings, and the stock market or their stock price would therefore reflect that weaker potential. And it's the same thing in reverse. If interest rates go down, it's less expensive to borrow. There's more spending or more borrowing, faster growth for companies, faster spending in the economy, stronger earnings for companies, and as such, stronger stock price growth. Secondly, there's a second round effect with all this spending. There's a kind of an indirect effect, which is where it affects kind of disposable income in the economy. If spending goes down, company revenue goes down, and the stock price goes down, it's a little bit similar, but it's kind of in the fact that kind of companies are all interrelated. So in every kind of industry, you're going to have companies that deal with one another, and as such, due to their interconnectivity, if one company does well, every other company starts to do better, and as such, this is kind of why you have the transition kind of between companies with to do with interest rates. Henry, do you have anything to add, or do we have any questions?
That was really well explained. Yeah, really well explained, Amrit. I think the one thing to add is that, well, so Wall Street and all the professionals, they know all this theory, right? They know they you know, the real basic in their head is high interest rates worse for stocks in the economy, low interest rates great for stocks in the economy. That's a massive oversimplification, as kind of all this presentation is, but that's what they've got in their head. And the point that I wanted to make was that what they'll do is you have some very, very clever economists, and they will try and forecast what they think these rate cuts or rate raises are going to be from the banks. And I remember there was one instance where, like, we didn't know if the US was going to raise by 25 or it was going to raise by 50. And what will actually happen to the stock market will depend on whether it's a greater than expected rate cut or greater than expected rate increase, right? So we've got, say, for example, we don't know if the US is going to raise by 50 basis points or 25 basis points. That's equivalent to 0.5% or 0.25%. Say, for example, the market is pricing in, it's going to raise rates by 30 basis points, the average. That's some very clever economists try and work out the isolationary effect of that. And say, for example, they only go up by 25, you might see the stock market go up as interest rates rise, just because the rate raise was less than what the market was expecting.
Yeah, it's a great point, Henry. I think you explained that really well. We do have a question, Amrit, from Max, which is, can you give some examples of when or why interest rates would be lowered?
Yeah, of course. So the main point would be you lower interest rates when inflation is too low and the economy is performing kind of less well than you want it to. So you want to increase economic activity in the country. Those are kind of two main kind of reasons why you do it. In terms of kind of times you do it, so typically recessions or slow growth periods. And yeah, you just want to kind of kickstart economic activity. Let's say interest rates are around 5% as they were kind of, you know, in 2006, 2007. We chopped them straight down to, I think, 0.5% in the UK, just to stimulate kind of borrowing, to stimulate the effects that we have here, the direct and indirect effects, to kind of get the stock market going, as well as, you know, more wider, more broad economic activity. Yeah,
I think that's the point, isn't it? Like, if you're in a recession, you lower the rates, and I guess it de-incentivizes saving and it encourages spending or borrowing. So that's the main point there, I think.
Definitely. I mean, I think, you know, one point that's really important for everyone to kind of understand is all to do with the relative rates of return on all these asset classes. If you've got your money yielding, you know, 1% in a bank account, or 4% in, you know, in this special like blue chip stock, or 8% in the wider, you know, stock market, you know, you need to kind of have some sort of portfolio where you manage to balance the risk and reward between all these different asset classes. So moving on, let's talk about GDP. GDP means gross domestic product, if you're not aware. And basically, it may sound like a technical word, but all it is the total value of finished goods and services produced in a country in a specific set of time. Typically, it's released on a quarterly and annual basis. And that's just because it takes such a long time to actually kind of collate and actually finalize. Typically, it takes about 2 years to actually finalize. but governments release estimates on a kind of a quarterly basis, and then more final estimates on an annual basis. So what does GDP, or the value of kind of all the goods that we produce, have to do with the stock market? Well, when GDP rises, corporate earnings increase, and as such, kind of the stock market as a whole increases. And when GDP falls, there's lower spending by businesses and consumers, which drives markets lower. So there's lower earnings, and as such, kind of lower stock market. So, but I think, let's just delve in a little bit as to why is this the case. So if GDP increases in a year, what does that actually mean? So that means that in, let's say, 2020, we produce more, I don't know what we produce in the UK, but let's say we produce, cars, food, financial services, etc. What does this mean for businesses? Well, if there's more money going in the economy, someone has to have it. So British businesses are doing, kind of better trade. They're doing, higher revenue, higher, I guess, contract orders, and all this, higher revenue feeds into kind of the overall economy, or the overall revenue of the British economy doing better. And it all just leads to kind of that same transition mechanism that we discussed earlier. Businesses do better, they spend more. Consumers do better, they spend more. Stock market rises, and the same in the opposite direction. Henry, do you have anything to add, or anyone else?
Very well explained, mate.
Okay, wonderful. Do you have any questions, David?
No questions. Just again, yeah, a really good point, Amrit. I think you. I like the way that you break it down very easily. I think you. Yeah, it makes a lot of sense.
Well, I mean,
you could mention how GDP is like, it's like a component of a few different things, right? Consumption, investment in industry, government spending. I think consumption makes up about 70% of this in like the developed world, right? I think it's about 65% in the UK. The more capitalist you are, the more consumption it is as a proportion of GDP. I think US is like 70%, right?
Definitely. I mean, you hit the nail on the head, Henry. You got your facts right. You got your economic theory right. So just to explain it a little bit more in depth, GDP is comprised of consumption, government spending, investment, and then net exports. I'm pretty sure it's those four. If there's any more? No. Okay,
I think so that's all we covered at the undergraduate level. But yeah, it probably gets a bit more complicated.
That's very true. There's a lot of extra bits, but let's just stick with those four. So consumption is just general spending in the economy on goods and services that kind of perish over time. So they're not kind of fixed capital stuff like I don't know, McDonald's burgers, cars, financial services, legal services, etc. Investment is stuff like investing in housing, investing in plant equipment, investing in even like investing in financial products, like that technically counts. Government spending, self-explanatory, it's just what the government spends in the economy. And net exports is whatever the country exports minus whatever the country imports. And typically what you'll find is developed countries like the US, Canada, UK, Australia, we have kind of trade deficits, and developing countries like China, India, I don't know, South Korea, just lots of other countries, they have trade surpluses. So that means that kind of trade aspect is a boost to the economy. It's kind of why Trump kind of came to power in the US. In 2016, he was rallying against kind of these trade deficits, saying they were a drain on the economy. But yeah, that's kind of just an explanation of GDP. If we don't have any questions, I'll move on to inflation.
Yeah, go for it.
All right. Okay. So inflation. So as we kind of touched upon earlier, a more formal definition of inflation is the change in prices for goods and services over time. So for example, if let's say a laptop, I don't know, an Apple MacBook Air costs £1,000 1 year, and then the same model, the same exact product costs £1,050 the next year, then the inflation rate for that laptop is 5% on an annual basis. It includes stuff like consumer price inflation, which measures the inflation for kind of consumers in the economy, and stuff like producer price inflation, input cost inflation for kind of businesses and other specific industries. Again, similar to GDP, typically released on like a monthly, quarterly, and annual basis by the government. And again, just like GDP, it takes a while to finalize. I mean, we're looking at like if you want to get the accurate figures for this month's inflation, I mean, you're looking at like 2 years from now that you'll actually find out what inflation was in November 2020. Henry, do you have anything to add?
It's good, mate. Very well explained.
So let's talk about inflation and the stock market. And we're going to use a slightly different way of explaining things, as well as we're going to break it down in kind of different asset classes or different equities. And yeah, so let's talk about it. So when inflation goes up, let's say inflation goes up in the economy, what does that mean to individual businesses? It means that input prices for those, whatever they use to. So let's say we're going to talk about a car company. Let's say we'll talk about Ford. So if inflation goes up in the economy, the price of steel, the price of leather, the price of, I don't know, all these engine components for Ford, they increase. Now, when these increase, what does that mean for Ford? Well, if Ford wants to maintain kind of the same profit margins, it wants to maintain the same, revenue, the same kind of, financial structure, it's going to have to raise prices, or it's going to have to do something to kind of claw back that money from customers. Well, if customers see kind of an increase in prices for cars, for Ford cars, they're not going to buy as many. They might not buy a car this year. They might just leave it be. But what does that do? So that ends up with Ford's revenue declining. And if Ford's revenue declines, as you guys are well aware, the stock price for Ford goes down. And kind of, broadly played out in the wider market, the overall stock market goes down. So this is kind of another way to think about inflation on kind of an individual micro level. And then going into kind of the kind of individual sectors of stocks, so value, growth, and income stocks. This is where I want to bring in Henry, because we had a good discussion about it. And yeah, I think you explained it quite well, and I can chime in as well, if that's all right.
Yeah, okay, so sure. So I think what I would say is that when we've got value, growth, and income, I would definitely say take that all with a pinch of salt, because at least in my opinion, it largely depends on the company. It largely depends on how well the company is able to change their prices and match. We talked about this, right? Like if a company if they've been lucky enough to get in some long-term contracts, and there's nothing in the contract that says inflation is gonna put this contract up, it's not an inflationary contract, then if that's a contract that's on their expenses side, then that's great. Their costs are fixed. But if their prices aren't that sticky and they can raise their prices in line with inflation, what's inflation done? Inflation is having a positive impact on income, at least in nominal terms, but the real costs are negative because these costs are fixed. And inflation is kind of eroding the real cost away. So that's what I would say is that broadly, yes, value stocks do better than growth in high inflation environments. But it depends largely on the company. I would say that with growth stocks, there's a lot more uncertainty in the future, and uncertainty is not great for growth stocks because so much of it is baked into the future. When it says income stocks usually decline, well, Amrit and I had a chat about this, and at least my conclusion and what we were saying was that I actually see income stocks quite positively, generally in inflation. This is a very general rule. Like these aren't absolutes between these types of equity class and inflation. But if we think about what happens to bonds. In order to think about income stocks in this situation, think about what happens to bonds in this kind of scenario. You've got interest rates going up. Contrary to how that sounds, that's actually really bad for bonds. It's bad for existing bonds, right? So if I go and bought a bond and it's yielding 8%, but tomorrow there's going to be a bond that it gets issued yielding 10%, that's really bad for me as a bondholder. So if I go and buy a bond and interest rates are going up, my actual existing returns on that bond are going to be really shit, because the moment the government issues 10% bonds, everyone's going to go and buy those. So you've got that. You've also got the inflation eroding away the purchasing power of these bonds. If you're getting fixed coupon payments and inflation is pushing them away, that's another reason that return on bonds are going to be shit when you've got inflation going up and higher interest rates trying to curb that. If you think about what income stocks are, they can be largely used as a bond proxy. an asset that gives you fixed income in the form of dividends. And a lot of the time, particularly if these companies have, as I say, prices that aren't that sticky, they're able to raise their prices along with inflation. That is usually pretty good for those income stocks, because investment vehicles that people that want income, they will go for these income stocks as opposed to the bonds, because as I mentioned, bonds are very risky in periods of high inflation with interest rates going up. The other thing that I would say with regards to that is you do tend to see stocks recovering much better from periods of high inflation than bonds. It's not the best environment for either asset class because high inflation is such high uncertainty, but you do see stocks in the long run performing much, much better than bonds. And I think a lot of that is just because inflation is so bad for bonds, you will see a lot of people shift over to stocks. And that's what the data suggests. If you look at a 1 year holding period of stocks and bonds, and it varies for inflation, you see this massive negative, whereas the inflation gets higher and higher, the returns get very shit for both asset classes. If you look at that over a 30-year holding period, the stocks drop a little bit, but not as much as the bonds.
Definitely, Henry. I think one thing that I think is really important, and again, I'm gonna just say it again. I think I've said this every single session, is you got to have some coherence when you invest. You've got to have kind of this thesis, and you've got to include not only the great thing that you do, which is kind of the micro, you've got to include some macro justification, and you've got to include, if you're looking at a growth stock like Tesla or something like that, you've got to, include some accommodation for what's going on with inflation, what's going on with the wider economy, because quite frankly, you can be caught out, like especially with the 1 year holding period, and just kind of the fact that during kind of high inflation times, volatility goes up, and you can get caught out. David, I noticed there was a question.
Yeah,
maybe that's just me.
We've had another one from Max, which is there any correlation between inflation and interest rates?
Well, Max is a clever guy. He's definitely deduced that. So to answer your question, Max, yes. And the way it works is typically inflation leads. So inflation goes up, central banks raise interest rates to kind of clamp down on inflation. Then once inflation kind of goes down to a normal level or a reasonable level, in their opinion, then interest rates start to go down. So there's I guess you could either call it a leading relationship between inflation or interest rates, or a lagging relationship between interest rates and inflation. If there's no more questions, I'll move on to kind of a time where I can show off all the employment, and then I can show off about myself.
Sure. I was just going to say, if anyone's got any questions about what value growth and income stocks are, we have covered it in a previous session, but if you want to know and you don't know, just put it in the chat and we can explain it very quickly for you.
It was session 2, about 15 minutes into the video.
Yeah. Okay. Well, no one said Amrit, so feel free to go on about the your next.
So next one is employment. And so what is employment? Measures the extent to which available labor resources, otherwise known as people available to work, are being used. So stuff like unemployment, the unemployment rate, so the number of people that don't have a job and want to work, or the employment rate, which is the number of people employed in the economy as a percentage of kind of the total population. Again, just like inflation and interest rates and kind of all of these other statistics, released on a monthly, quarterly, and annual basis. And again, just like I say with all of these, very, very hard to find out at the time. Typically, it'll take 18 months to 2 years to actually finally figure out, to the exact person, what's going on. And yeah, I see my chat function like kind of blowing up. David, is there other questions, or is that just like?
No, sorry. Someone just asked if the last session was recorded, so I just sent the YouTube link.
Okay, all right, cool. So let's talk about employment and the stock market. So let me just move this out the way. Let's say employment goes up. So if employment goes up, what does that mean? There's more people in jobs. Well, what does a job give you? A job gives you money. So if you have more money, you have more consumer spending. If there's more spending in the economy, company revenue goes up, as such, kind of investors value companies more, they can pay more dividends, etc. And stock market goes up as a whole. Stock prices for companies go up as a whole. Same thing in reverse. Let's say employment goes down, fewer people in work, there's less consumer spending, less company revenue. Stock prices go down because companies can't support their valuations. Yeah, I mean, this seems kind of pretty self-explanatory, and I think everyone can kind of work through this. The whole idea is just you want to try and think, okay, this has happened, what does this affect, and what does this affect, and what does this affect, and kind of get that transition mentality of kind of all these mechanisms. Yeah, I mean, Henry, do you got anything you want to add? Or
we could briefly explain the Phillips curve. Phillips curve? Yeah, Phillips curve.
The Phillips curve, okay. That's very interesting. Okay, so the Phillips curve is the relationship between employment. Well, I think it's actually the relationship between unemployment and inflation, if I'm correct. Yeah. Hey, there you go. So you remember in my third year. So specifically, what it has to do is with in times of low unemployment, there's high inflation, and in times of high unemployment, there's low inflation. And let me just we'll just explain why. So let's say if we're in a time where there's like no one unemployed in the UK, let's say everyone's got a job. Well, if everyone's got a job, well, the main thing a job gets you is money. What are you going to do with that money? You're going to spend that money. If you spend that money in the economy, and you have higher demand for businesses, what's the one thing a business wants? What a business wants is more money. So they're going to raise their prices. If they raise their prices, the price level in the general economy as a whole has gone up. Therefore, that leads to inflation. Let's think about it at the other side. Let's say no one has a job. Okay, so if no one has a job, no one has money, because that's the one thing a job gets you. So if no one has money, they can't buy anything from businesses. Businesses can't raise their prices. You're going to end up with a situation where businesses actually cut their prices because they just want to get some kind of demand and some kind of revenue. And that's kind of an economic concept called the Phillips curve. Very interesting, held true until the 1970s. Not so much true now, but still quite important to know, especially in developed countries. Apparently, it's kind of having a resurgence, and definitely has a resurgence at very low levels of unemployment. So around 3% in the US, you kind of start to see this relationship build. Do we have any questions?
Yeah, I've got two for you. First one was sent in privately, which is, are there any examples, I guess, historically, when the idea of high employment leading to a higher stock market hasn't held true?
Well, okay, so to answer that, we can look at right now in the US, we can see, I want to say 40 million people in the US, they're furloughed, they're not at work. So we've got kind of a relatively weak employment picture. But as I'm sure you guys are aware of, last week, the Dow hit 30,000, highest level ever, and you kind of have that disconnect between the stock market and employment. And that's all to do with the Fed just pumping in trillions and trillions and trillions of dollars. And alongside all of that, you get Bitcoin going up to all-time high today as well. So, but that's your answer, David.
That's great. And then we've had one from Ethan, which I guess kind of relates to what you've been saying about the Fed in America, which is, how do you see the Fed's recent decision of allowing a variable interest rate affecting global economies going forward?
So I don't quite understand the question, to be honest, Ethan. Like, what do you mean by variable interest rate?
I'm also a bit confused by it, but Ethan, if you want to put your mic on, feel free.
Sure. So it used to be a target of 2%, but recently they've let governments change it from above 2% or lower than 2%. So in particular, how's it going to affect like the debt burdens on the economies?
Is that inflation or interest rate?
You see the inflation target, 2%.
I was going to say,
yeah, that's the one.
Inflation.
Yeah, that's the one. Yeah.
Oh, okay. All right.
Typo,
okay.
sorry.
No worries. So, okay, let's talk about then variable inflation. I'm sure we all got our points of view. Basically, it gives the Fed more room to either hold rates longer, lower for longer, or just kind of allow more flexibility to allow, let's say, a new quantitative easing program. Broadly speaking, it's not committing the Fed to say, okay, inflation's at 2% or inflation's at 2.1%, go on, quick, let's raise interest rates, quick, go, go, go. It's allowing kind of the Fed to have that flexibility to say, well, you know, we're going to see how things go. We're going to support this. We don't want to crush the economy by immediately increasing interest rates when inflation's slightly higher. Henry, do you got anything you want to add to that?
Well, yeah, I mean, I would say it certainly gives politicians a bit more control. It's quite interesting we just mentioned the Phillips curve because yeah, if you think about it, obviously, you know, with this relationship between inflation and unemployment, you almost have this kind of like this battle where you might have very conservative politicians, fiscally conservative politicians thinking inflation's more important. You might have others that are more concerned with kind of the social aspect of employment. They might not care if the economic growth is the fastest, but they want everybody to be employed in a job. So I would say that when you've got this variable inflation rate, or not so much fixed on that target, it certainly allows more flexibility in that regard. It's interesting. It almost gives the politicians a bit more power between, you know, do we want to go fiscally conservative or do we want to be a bit more helpful to people? It's not something I've really thought about, to be honest. You could think about the implications with regards to QE. You know, if they're worried about QE being inflationary, does it give them more wriggle room? I don't know much about the reasoning behind removing the 2% target, but you know, a component of that might be if the interest rates are so low and we've got we don't have that lever to stimulate the economy, we have to stimulate it by QE instead. Is it allowing QE a bit more acceptance if then QE pushes the inflation rate above 2%?
I think that's definitely valid points, Henry. I think one point I really want kind of people to understand is this is really interesting. It's really cool, and it's, you know, it's definitely kind of quite technical. I don't want people to feel like afraid or daunted when they think about like, oh, quantitative easing, all this stuff like that. You know, if all you knew was just kind of these transitions, that's all you'd need to know to kind of form an investment basis. You know, as I'm sure kind of Henry and David would agree, you know, the fact is an individual company matters more. You know, their corporate policies and their kind of individual factors matter more than what the wider economy is doing. Just because kind of in any market you can make money, in any market there'll be companies that do well, and it's your job as investors to kind of find those companies and not so much worry so much about kind of broadly what's going on in the economy. If we don't have any questions, we'll move on to the last one.
I'll just say that's a really good point, Amrit. Like, these things are 100%, they're very useful and important to know about. But this is why I'm more of a micro company guy, is that it's much easier to predict what's going on in an organization and understand that, as opposed to the global economy. You know, economists and forecasters, they kind of get this wrong all the time, and there's just so many components to it. But yeah, nonetheless, it's very important to understand.
Definitely, Henry. I mean, this was my full-time job, and I'm not going to lie to you, I got this wrong like routinely. So, you know, you take it with a pinch of salt. So lastly, I want to talk about the Purchasing Managers Index, which is, so basically it's a monthly data, a monthly survey kind of senior executives of private sector and companies around the world. And what it does is it provides an advanced look at all of these factors. So GDP, inflation, exports, capacity utilization, which is good for supply chain planning, employment, and kind of like inventory. Like inventory like factors. And the reason why like I want to bring this up is these, you know, numbers are, you know, very obsessed with in the market, because they're provided every month. At the same time each month they provide a snapshot of, you know, the closest thing to a real-time snapshot of what's going on in the economy, compared to kind of GDP or inflation or, you know, all these other factors like employment, which takes like, you know, around 2 years to get right. These are, you know, as perfect as they can be, you know, every single month on the dot. And another thing why I'm quite passionate about it is I actually worked in a company called IHS Markit producing these. And as a kind of a little, I don't know, a little plug or a little show off to myself, here's some quotes of me in kind of different places. So This is me, for Saudi Arabia in Reuters. This is me for Italy in the Financial Times. This is me, I think, with Italy as well, maybe another economy in Bloomberg. And this is me with my analysis of Ireland in the Irish Times. I'm also in the Wall Street Journal, if you guys read that. So so definitely some cool things, which something I'm proud of, and I kind of know what I'm doing, so it's kind of cool. So what do these things have to do with the stock market? Well, it's not so much the number per se. So the way the PMI works is they come out with, let's use employment for an example. So we're going to use UK manufacturing employment PMI. It comes out with a number that's let's say it's 47. And the way the index works is it takes a value of 50 if there's zero change in whatever that index is over that month. And every value above 50 is a growth in that sector or growth in that index. And every factor or every number below 50 is a contraction in that sector. So basically, let's say UK manufacturing employment PMI is 47. Well, what's it telling you? 47 is below 50. I think that's what PhD taught me. And as such, that means that there's kind of been a slight decrease in employment in UK manufacturing, UK manufacturing sector. So what does that mean then? Well, you're not going to necessarily look at the PMI any further. Just as I've been saying kind of throughout this presentation, you're going to look at the transition mechanism. Okay, employment is weak. What does that mean? Well, employment is weak. Fewer people have jobs. Fewer people have jobs, less spending. Less spending. What does that mean? Oh, less company revenue. Or what does that mean to stock prices? Oh, stock prices go down. And then that's going to affect your analysis. And yeah, that, I mean, the PMIs cover kind of stuff like output, business activity as a whole, input prices, output prices, employment, future expectations. So, how optimistic a company is, et cetera, et cetera. And lastly, I'll do Q&A.
Amrit, that was a brilliant session. Very, very easy to follow, and really, really interesting. It was great to see your quotes from all the different news outlets there. Very, very impressive. So yeah, if anyone's got any questions, feel free to either type them in the chat, or you can put a thumbs up or whatever the thing is. Just if you want to turn on your mic, feel free. It'd be great to hear your thoughts, your questions, just to put Amrit to the test.
Okay, I'll try.
Amrit, I've got a question about the PMI, because this is something I know much about. So like, I was wondering how exactly is it calculated, and do you have different PMIs calculated different ways, right? Because you could do it really simply, where it's just like everyone that's had a decline in X, it goes below 50, or everyone that's had a decline above goes above 50, and then it's averaged out. Is it like or is it like weighted? So like if someone supports like a severe decline and then there's a severe gain, is it all like averaged out? Okay,
so it's something called, so to answer your questions kind of in order, it's the same methodology throughout all indices, apart from one, which is the future expectations, which has a separate methodology. But it allows you, and as such, because of that, it allows you to compare countries and sectors. So you could look at like the US output PMI of like 47 and the UK PMI of 53, and you could say, oh, the US is going down, the UK is going up, and you can accurately compare them. The way it's calculated is something called a diffusion index. And it sounds more technical than it is. It literally is, you ask people a question. And so let's say, we'll talk about output. So you ask companies an output question and you say, has your output gone up, gone down, or stayed the same over the past month? And if it goes up, you assign a value of 1. If it goes down, you assign, oh no, sorry, if it, wait, let me double check. 0, 1, yeah, if it, oh, I tell you what, I think I'm messing up my facts.
Is it 1, 0.5 and 0? And then
correct. Yeah, you're right. There you go. So if it goes up, you assign a value of 1. If it stays the same, you assign a value of 0.5. So, yeah, cool. And then if it goes down, you assign a value of 0. See, this is why I wasn't involved with the calculating of it, because it's just too technical for me. Times and things by 0.5. But oh, sorry, go on.
That's just quite interesting, because like, so it's not like, what I mean is, it's not like there wouldn't be. It doesn't matter like how much of an increase or how much of a decrease.
Oh,
It
no.
just matters the
No.
direction. It's quite because there could be like quite negative implications of that. Say like if you had like Apple said, their manufacturing was up by like 50%. And then you had this tiny company with a market cap of 10 million said their manufacturing's down a tiny bit. And if it was just those two companies in the whole economy, for argument's sake, then the PMI would be 50, right?
So you would think so. However, the way we get around it, or the way the great guys there get around it, is they have this thing called weighting, and they just value weight the industry. So if Apple's accountable for like 99% of revenue, whatever they say would account for 99% of the index. And my friend Phil deals with that, and he can tell you more about it. But yeah, I noticed there was a question, David, or maybe that's just me looking at.
Yeah, no, we've had one from Max again. I don't know if it kind of ties into what you were just talking about before, because I know you did mention future expectations, but he says, does the PMI have future influence on the markets?
Yeah, 100%. So the PMI, because it comes out every month, so PMI comes out, let's say in January. Well, basically the way it works out, it comes out 2 months before GDP data. And so you end up with very interesting kind of aspects of like the leading indicator aspects of kind of a PMI. So the PMI would drop, and then GDP would be shown to drop kind of 2 months later. So investors looked at the PMI, this is especially the case in 2008 financial crisis, and especially actually around Brexit as well, which is quite interesting. You see the PMI start to drop around kind of, mid 2008. And then, everything's officially going okay, it's going fine, nothing to worry about. Then GDP falls off a cliff. So if you're following PMI, you had that kind of edge on the markets to, I don't know, invest or sell your houses or, get out the market.
Would you say this has been a really good leading indicator historically?
Oh yeah, definitely. So like I should have showed off and showed you some of my research reports, but there's a report I came out with the Italian market, where the Italian composite output PMI, that's the Italian output for the entire economy, services and manufacturing, has like an 86% correlation with Italian retail sales. So it's quite impressive. I mean, the way it kind of is packaged is, all these quant funds and hedge funds, they get all this data, they send it to someone far cleverer than I to deal with the data and sift through and find patterns. And they say, okay, it has a correlation with, let's say, retail sales. Let's combine it with these other factors and create a trading model based on that.
Interesting.
Great. As far as I can see, we've got no more questions at the moment in this chat. We've not got anyone with their hand up. So I think we can wrap up there, unless anyone's got any other last minute questions to throw in. We do. We got one from James, which is, can you recommend any good books for beginners? James, we're going to put out a reading list, hopefully in the next week or two, which will have everything that we recommend in terms of reading. It'll be tiered, so we'll have, for absolute beginners, kind of slightly more advanced, and for different categories within investing and finance. So look out for that. We'll put it on social media, on the WhatsApp group, by email, so you'll be able to find it. So I hope that answers your question. And
any very basic books on macro, please let us know. I know a lot of very complicated books on macro. There, as you guys have probably seen, there's a million books about like how to get started investing in shares, and some of them are very good and they'll be on our reading list. But I do not know a good resource of very basic macro. The stuff that Amrit's talking about tonight in very basic, easy to understand terms, I haven't seen much out there like that. Probably because this stuff is so complicated. But if anybody knows a good resource for that, please.
I've got an idea on that. I would genuinely recommend to you guys to read A-level economics textbooks, or A-level economics like revision guides. This is literally like, the type of stuff. I don't know if you guys did economics A-level, I did, but it was the type of thing that we were talking about, like the transition mechanism and the impact of interest rates on the economy, etc. Pick up a book. I mean, go online, look at, I think it's called like Tutor to You or something. Yeah, and that will really help. Like I said earlier, you don't need to be a PhD level economist to do this. Like anyone can kind of understand these, transition mechanisms, and you're welcome to ask me a question or watch this again. But A-level economics textbooks, really, really recommend.
It's funny. I was literally just about to say,
oh, nice.
This is what I did. I haven't done econ since A-level, but this is exactly what we did at A-level, and something like a very simple textbook would be perfect. So yeah, 100%. I guess I can add the textbook that I had to the reading list as well, because it was quite helpful. Ethan has said he found the Bloomberg Market Concepts online course great. I guess that's in relation to getting started. I know that as UOB students, we get free access to that course. I can send a link for that if anyone wants, or you can just type in Bloomberg Market Concepts. You say you're a UOB student and you get it for free. Yeah, look, if that's everything, then great session, Amrit. Thank you very much. On Thursday night, we're going to have Alpha Room at 6:30. For anyone that doesn't know, Alpha Room is a bit more discussion based. We're not leading anything. It's just literally a conversation between anyone that attends. I actually think that we're going to have a couple of stock pitches, one from Henry and one from Ryan, who is here. We're going to have a discussion on vaccines.
Is it all right if I put slides together, mate, for our trip?
Yeah, 100%.
I promise you.
We're going to keep it very short and sweet, purely conversational, like it was last Thursday, where we discussed Amazon, we discussed electric vehicles, and it's a great chance to hear your views, to hear different ideas. So please feel free to come along to that. I will send the link to that, because the one in the email that I sent yesterday will also be wrong. What else? I guess we'll have a couple more of these before Christmas. We'll keep it going after Christmas. We're going to start the virtual fund, and yeah, stay involved, stay in touch. Any questions, let us know. We've got the WhatsApp groups that you can message us on. We're all contactable quite well. And yeah, get your housemates to sign up for this, and course mates, get them to sign up for our investment society, because we want to hit 500, and we're going to do a ridiculous giveaway when we do. So yeah, hope to see you guys on Thursday night, and thank you for joining us. Thank you, Amrit. Thank you, Henry, and have a great night.
Thank you, David.
Cheers, guys.
Thank